Most people in crypto dollar cost average the wrong way. It's not because dollar cost averaging is bad, also known as DCA, or that they even know that what they're doing is right or wrong. So this has nothing to do with whether dollar cost averaging is good or bad. But if they turn dollar cost averaging into blind buying, no plan, no levels, no risk management, what's going to make them stop, even if the price goes to zero? Remember, none of this today is financial advice, and this is educational only. Please manage your own risk. Crypto is risky. In crypto, choosing when to buy does matter because when you're buying Bitcoin, Ethereum, or other strong assets over time, it can be a powerful strategy by using dollar cost averaging. But if you're just buying random altcoins every week just because they're down 80%, that's not discipline. You're just gambling. That is just a slow motion holding the bag with a calendar reminder that, hey, you just lost a lot of money. So, in this video, I personally want to break down regular dollar cost averaging for the newbies, dollar cost averaging for those who have been in this space for a while, a method I like to use myself, and how I'm personally thinking about building positions without pretending I can time the bottom and the top. So, what is dollar cost averaging, or DCA for short? Instead of trying to buy everything at one perfect price at the perfect low, like this little spot on the chart or this little spot on the chart or this one, you're buying a fixed amount of an asset on a reoccurring schedule, whether that be every week, every 2 weeks, every month, or every day. You set that standard amount of Bitcoin, Ethereum, Solana, or any other asset that fits into your long term plan. Remember, the point of this strategy is not to be perfect, but the point is to remove emotion. You're not waking up every morning and asking, hey, is it the bottom? Is it the top? What do I need to do? You're not panic selling every green candle. You're not freezing every time the market dumps. You're just using a system. You're buying Bitcoin here. You're buying it here. You're buying it here. You're buying it here. And you're buying it here. And right now, it's what? It's sitting at 76,770. This is why dollar cost averaging works best for people who have a long term thesis, a steady cash flow, and enough patience to survive the volatility. That means they are a long term investor. And many times, even in this space, those long term investors end up on top at the end. Anyway, but we're looking at the Bitcoin chart and we are talking about Bitcoin, which is the strongest asset in the crypto space. Big Daddy B doesn't have to worry so much if the tokenomics are bad because it has excellent tokenomics. So, dollar cost averaging is not going to fix a weak asset. If your project is weak, if the tokenomics are bad, if your narrative is dead, or if you never had conviction in the first place, dollar cost averaging can actually make your problem worse. You're not really lowering your average at this point, you're increasing your exposure to a bad decision. Now, I want to talk about dynamic dollar cost averaging, especially now that we have the Bitcoin chart up. Dynamic DCA is a more disciplined buying strategy, but you're not buying the same amount every time. Instead of buying the exact same amount no matter what, you're adjusting it based on market valuation, your risk, and your own portfolio allocation. The simple version is this: when the price is high or extended, everyone's euphoric. When Bitcoin was sitting at $124,000, you're not buying that much or not buying any at all. When your pulls back to major support, fears increasing in the market, you're buying more and more and more. So when the price pulls back, you're not aping in, but you're buying a heavier allocation than you were. It means you're scaling in with a plan. That's exactly what dynamic dollar cost averaging is. It's like looking at the Bitcoin chart right here, and you're like, well, weekly, once we drop below the bull market support band, I start buying, I don't know, $50 a week. And when we break below the 50-week moving average, that's kind of where we're at now. Maybe you're buying $100 a week. And if we break below the 200-week moving average, which honestly is sitting right around here right now, around $65,000, $64,000. I don't have it on the chart. That is an estimate. Maybe your dollar cost averaging $200 a week. I am right now operating on a similar plan to this. If we break through the 200 week and we're down around, below $60,000, maybe you triple or quadruple the dollar cost average amount. But see, the key is this: you're defining what you're buying before your emotion hits. Because when the market is dumping, your brain's not calm. And when your portfolio is red, Twitter is bearish, or X, as they say these days, and everyone is calling for lower prices. That's truly when most investors freeze. They either panic sell or they don't buy with size when they wish they would have. But now let's take a look at my operator framework. And here's truly how I would frame it: standard dollar cost averaging. Here is how I would frame it. Standard dollar cost averaging is the best for discipline. It's simple, it's very repeatable. It all definitely keeps you from overthinking because you just buy the same amount weekly or monthly, whatever. Likewise, or excuse me, on the other hand, dynamic dollar cost averaging is best for investors who understand a little bit more about market structure or at least have a plan in place. But they have to be able to stay honest with themselves, right? So maybe your base buy, like we were saying, might be $100. You get near the resistance, overheat it. You're only buying $50 instead of 100 because the market is up and it pull back to support. Maybe you start buying closer to $200 with that DCA. But that is an example of a weekly dynamic dollar cost averaging. So remember, dynamic dollar cost averaging is the same schedule, but there's dynamic sizing, and that is based on market conditions. Because remember, dynamic dollar cost averaging can turn into excellent market timing if you're careful. But if you're not careful, that's where people mess it up. They say they're being dynamic, but really they're just chasing pumps. They're skipping buy. They buy the fear. They buy heavier after the asset's already moved because they're not really following their plan. That is backwards. For me, dynamic dollar cost averaging needs rules in place. Rule one: use it only on assets you actually want to own long term. That is the most important thing because we don't want to be left holding bags of something we just jumped on the hype train and now we're left holding it. And now we're like, what do we do with this? Rule number two: always have dry powder on the side. If you spend everything on the first dip, you're not dynamic dollar cost averaging, you're just early. Rule three: use zones, not perfect prices. And rule four: never dollar cost average into something just because it's down. And rule number five: know what validates your thesis and when to sell out, when to stop your DCA. That last one actually probably matters most because process over prediction does not mean buy it forever. It actually means have a plan and know what you're going to do if that plan changes or if the criteria changes and you need to change the plan. So, if you want more real time updates on how I'm thinking through markets, positioning, trading, and DeFi strategies, I post more of that in my free Telegram group. But just remember, the big takeaway is this: dollar cost averaging will help you avoid emotional timing. Dynamic dollar cost averaging is going to help you do that adjustment to market structure a little bit more advanced, but still pretty easy to do. But neither one of those strategies is going to save you from bad research, bad assets, or bad risk management. The goal, remember, don't buy every dip. The goal is build that position with discipline, patience, and a plan. And when that big dip happens, you're ready to go in with size. So remember to like the video if this helps, subscribe to the channel for more practical crypto and DeFi education. Comment below. Do you use a regular DCA or a dynamic DCA method? Or are you really just still trying to time the perfect bottom? Just be honest and let me know in the comments. If you want to go deeper, check out DADSDEFISPACE.org, our free course. And remember, this is educational only, not financial advice. Always manage your own risk. And until next time, ladies and gentlemen, peace